Good morning, everyone. Welcome to Washington, D.C. Thank you all for being here today. It's my pleasure to call this meeting to order and welcome you all to the fall meeting of the PCAOB Investor Advisory Group. Before we begin, I'd like to note the standard disclaimer. The views I express today are my own and they do not reflect those of the PCAOB board members or my fellow colleagues. We have a full agenda ahead of us, but before we dive in, I'd like to extend my gratitude to Amy McGarity, the co-chair of IAG, for her leadership, partnership, and continued collaboration. I'd also like to express my thanks to all the IAG members for your support and for being here today from all over the country. We truly value your time, perspective, and commitment to this vital work. With that, I'll turn it over to Acting Member George Boric for his opening remarks, followed by introductions and brief comments from the board members. Thank you.
Great. Good morning, and thank you, Saba. It's great to see everyone, and thank you, Saba, for the kind introduction. Amy, for you also being the co-chair of the Investor Advisory Group, and for all the members that are here today. And being in person, I think, is helpful for those that could make it to enhance the dialogue. Since the inaugural IAG was established in 2009, under the leadership of former PCAOB board member Steve Harris, the IAG has long served a specific purpose for the PCAOB board and staff. Your input, perspectives, and experience are critical in helping the PCAOB meet its mandate of protecting investors under the Sarbanes-Oxley Act. And I want to thank you all for volunteering your time and energy on behalf of investors. We certainly recognize the time devoted to the IAG is precious. It's precious work. Given your many other responsibilities, we don't take for granted your commitment to the PCAOB. Now, before I proceed, I'll give my disclaimer as well, that the remarks this morning reflect my individual views as an individual PCAOB board member and do not necessarily reflect the views of the full board, my fellow board members, or the dedicated staff at the PCAOB. From individual and collective letters of support for the PCAOB's unique mission to protect investors, to supporting and uplifting the work of our incredibly talented staff, the IAG was an incredible source of support for the PCAOB this year. This is in no way a surprise, as the IAG has always been a champion of the PCAOB and our investor protection mission. In fact, I would submit that the IAG is woven into the very fabric of the PCAOB. Speaking at an IAG meeting in October of 2026, former PCAOB Chairman Jim Doty summarized the accomplishments of the PCAOB and gave credit to the investor community when he said, and I quote, "The PCAOB has accomplished a great deal in its short life of less than 14 years. So far, including some major achievements, but they could not have been accomplished without the sustained interest and support of investors," close quote. Although we are nearly 10 years removed from Chairman Doty's statement, it still rings true. At its core, I believe the PCAOB is and must be a listening organization. We must not only continually engage with stakeholders, but more importantly, we must actively listen to all our stakeholders. For example, just last week, Board Member Thompson hosted the most recent PCAOB Small Business and Broker-Dealer Forum in Irving, Texas, which underscores the PCAOB's listening commitment to the unique perspectives and experiences of smaller firms. Our colleagues in the Office of the Chief Auditor recently formed a small firm resource group, bringing together representatives from smaller firm practice to share their firsthand perspectives with us. And in that same vein, the IAG was formed to provide a public forum for the board and staff to hear from the broader investor community on audit or oversight matters that affect and are of importance to investors. It is outlined explicitly in the Sarbanes-Oxley Act that the PCAOB was created to oversee the audit of public companies in order to protect the interest of investors and further the public interest in the preparation of informative, accurate, and independent audit reports. In fact, It was the law's namesake, U.S. Senator Paul Sarbanes, who said about 5 years after the act's passage that, and I quote, "If you don't protect the interest of investors, it deals a major blow to the workings of the economic system. Investors, after all, make the whole thing work. They are the ones who are providing the resources so the entrepreneurial system can move forward, innovate, expand, and contribute to the strength of the economy," close quote. For many years, the IAG has faithfully reported the perspective of investors and served as the connection to and arguably the PCAOB's most important constituency, investors, the ones who, in Senator Sarbanes' words, make the whole thing work. We are and continue to be grateful for all that you do. Now, during my 22 years, I'm scared to say, but 22 years at the PCAOB, I've witnessed and experienced firsthand the value the IAG brings to the PCAOB. The IAG has raised important issues concerning investors. In my prior position as the director of the Division of Registration and Inspections, I recall many interactions with the IAG regarding our inspection activities. These discussions always cause me to think and reflect more deeply on our work in new and different ways. Today, you will continue this incredibly important role with a discussion moderated by the IAG co-chair Mary McGarity and IAG member Gary Walsh on evaluation practices for private assets, which is timely and important topic for investors right now. Our own Dr. Josh White, acting director of the Office of Economic and Risk Analysis, will then lead a conversation on the recent congressional testimony regarding the requirements under the Act for audits of ICFR, or internal controls over financial reporting. I'm also looking forward to hearing more about the IAG's selection regarding the most decision-useful critical audit matters, CCAMs, or key audit matters, KCAMs, contained in public company audits from the preceding filing year. Like all of you, I speak frequently about the importance of transparency, both from the standpoint of investors, firms, audit committee members, and other stakeholders having a clear view of the PCAOB's oversight activities and areas of focus, as well as from the standpoint of capital market participants who want more insight into the audit process. CAMs are integral to investors gaining an enhanced understanding of the audits that are performed for their benefit. I want to specifically thank Jeff Mahoney for leading this important initiative for the second year. This is number 2. And all that were involved, I know many were involved around this table in this significant endeavor. Then, given the worldwide nature of auditing, it is only fitting that Christine Gunier and Julie Rabus in the Division of Registration and Inspections provide more information on our non-U.S. inspection activities, as well as our ongoing collaboration with non-U.S. regulators. Our regime of joint inspections is a vitally important component of our auditor oversight activity, and our engagement with non-U.S. regulators ensures that registered accounting firms performing audits of U.S. publicly listed companies are held to the same standards and rules as accounting firms located in the U.S. Now, we have a full agenda today, but before we turn to the matters at hand, I do want to acknowledge the PCAOB's decision to postpone QC 1000's effective date for 1 year to December 15th, 2026, after learning that some firms faced implementation challenges meeting the previously established time frame. The board believes that an additional year is sufficient time for firms that have encountered implementation challenges to overcome those challenges. Additionally, firms can also begin complying with the requirements of QC 1000 before the new effective date if they wish to do so. Given the importance of a firm's system of quality control to the performance of high-quality audits, it is vital that firms are successful in properly implementing the new standard, because that means investors are better protected. Now, as I conclude, I want to share an update on our 2025 inspection activity. While our 2025 inspection procedures for the 6 U.S. global network firms are still underway, preliminary results show a decrease in Part 1A deficiency rates from 2024. This early data, suggests that the efforts by these firms during the past few years are positively impacting audit quality. Now, I'd like to close my remarks reflecting on the very first IAG meeting in 2010, when board member Steve Harris said, and I quote, "Throughout today's meeting, I would like to ask that each of you keep in mind and seek to answer the question, how do we make audits more relevant to investors? How do we make audits more relevant to investors?" This question is as relevant today as it was in 2010. I too would like to encourage all of us to continue thinking about that question, how to make audits more relevant to investors, and how each of us can strive to make audits, again, more relevant for the investor. And again, I want to extend my deepest gratitude to all the IAG does and all you will continue to do on behalf of the PCAOB. I look forward to an engaging discussion today and dialogue. And now with that, I will turn to my fellow board members to see if they would like to make a statement or say a few words. And after that, we will open the floor for questions or comments. So with that, Board Member Ho.
Thank you, Acting Chair Bode. Good morning and welcome to the fall IAG meeting. I'm sure everybody knows, but I will reiterate that the views I express here are my own and they do not necessarily represent the views of the PCAOB board, my fellow board member or staff. Investors are the driving purpose behind PCAOB's existence. As you know, Congress established the PCAOB over 20 years ago with a mission of investor protection, which I believe can best fulfill by improved audit quality. However, being an audit regulator is complex and challenging, as audit involves judgment and is thus more than a check-the-box exercise. Judgment is a human cognitive function, and regulating judgment is akin to regulating other cognitive functions like decision-making, creativity, and learning, which are highly subjective areas. Therefore, regulating such areas requires deep expertise, balanced considerations of interconnectivity, and humility. I want to briefly share with you the 3 core principles that guide my decision-making and regulatory approach. First, proportional regulation. Regulations should be well-designed and proportionate to the problem we're trying to solve. Overly burdensome regulation can reduce competition, drive up costs that are ultimately borne by investors, and paradoxically harm the very audit quality we seek to protect. Second, focus on material impacts to investor protection. Our regulatory approach must prioritize deficiencies that are material to the reliability of financial statements and the associated audit reports. Real investors want auditors to perform adequate procedures to test financial statement reliability and provide reasonable assurance on such statements. We must avoid a check-the-box compliance mentality that misses the bigger picture and fails to distinguish between material deficiencies and those that are not material to investor protection. Third, promotion of innovation while avoiding regulatory overreach. The digital age demands that we embrace innovation, enhance audit quality, particularly artificial intelligence and emerging technologies that can enhance audit quality. Regulatory clarity is essential to achieving efficient, high quality, and hopefully one day, continuous audits. We must develop standards that promote technological advancement rather than discourage it through regulatory uncertainty or punitive approaches that cause firms to fear and avoid beneficial innovations. I am committed to ensuring that our regulations genuinely serve investors through thoughtful, proportional oversight that enhances audit quality while preserving the competitive, innovative environment necessary for robust capital markets. Thank you for investing your time to help us be a better regulator. Finally, I want to give a special shout out to one of our IAG members, Gina Sanchez, who participated in our Technology Innovation Alliance Working Group Roundtable. The tier recommendations were recently published, and I am looking forward to more discussion on the responsible use of AI and emerging technologies to promote audit quality. Thank you.
Great. Thank you, Board Member Ho. Board Member Stein.
Good morning, everyone. I'm going to quickly do the disclosure that the views I'm speaking today are my own and not those necessarily of the PCAOB, my fellow board members, or the staff of the PCAOB. I'm very pleased that we're here gathering in our main office of the PCAOB with everyone here today. Thank you again. I say pro bono efforts, but your volunteer efforts for coming all the way here, spending hours in virtual meetings, to prepare for our meeting here together. I think this group represents some of the very best of the Sarbanes-Oxley Act. It's that investors should understand the forces that shape the audit and the auditor's work, and to provide us with your perspectives on how to help shape the way audit results are presented to the public. I love George picking up on Steve Harris's quote, how do we make audits more relevant to investors? It's just a nice, succinct way to sort of think about what we're all trying to do together. I'm intrigued by the topics that you are going to be speaking about today: the valuation of non-publicly traded assets, internal controls over financial reporting, always one of my favorites, and foreign inspections. Valuations are fascinating right now, especially in the non-public context. It's always challenging for the auditor to audit, what a company or broker dealer has put on their balance sheet. I know here in Washington, there's lots of discussions going on around mutual funds and other collective investment vehicles purchasing non-public assets, much like a private equity firm would. And the way those valuations are going to be done is going to be new and I think potentially challenging. So there is a aspect of this that PCAOB registered auditors are going to need to look at. I think the panel about the challenges of valuation in a sector with limited liquidity and how we should respond to that as the board, as an audit regulator, is very timely. As Board Member Ho mentioned, we're also living in a world where new artificial intelligence tools are rapidly changing what is possible, both in the audit, but maybe more importantly, in the way that a public company or broker dealer is putting together their financial statements. I think it's raising a lot of questions for both sides of that integrated audit. So whether that's the audit of the financial statement or the internal control over financial reporting. And I think we can imagine a world not too far distant in which much of a preparer's work is done with AI tools. And I think it's a fascinating question to think, how should that work be audited? Is it also going to be audited with AI tools? What internal controls are possible and appropriate? How does the human stay in the loop to review or check or confirm this work? And I'm also looking forward to our division of registration inspection about our inspection of non-US audit firms that have audited or helped audit companies listed on American stock exchanges. As we know, auditing in today's capital markets commonly requires a global network of audit firms to work together. And on the audit regulator side, it's not easy, to inspect audits of US listed companies across either a diverse network of foreign member firms or a standalone foreign firm. So I look forward to our practical discussion about how we're carrying out those inspections. So once again, thank you for your service and your engagement with the important work that we do at the PCAOB, and I look forward to today's meeting. Thank you.
Thank you, Board Member Stein. Board Member Thompson.
Good morning, everyone. I always look forward to these opportunities. They are kind of a highlight of the year to have the IAG come in and speak to us, and we do a lot of listening. So again, thank you. And like my fellow board members, you know, the ideas or anything I express are mine and not those of the staff or other board members. So having said that, I go back and I think about the relaunch, the establishment of the Investor Advisory Group in March of 2022. That was a priority of the board. One of the first things we set to task to do was to make sure that that was reinvigorated, which was an incredibly significant step, in my view, in the life of the PCAOB. It sent a clear message that in executing our investor protection mission, it was essential that the board hear directly from investors. During the course of my tenure as a board member, I have tried to be a good listener. In some instances, I've met with IAG members one-on-one to discuss matters pertinent to our regulatory agenda. I've served on panels with those in the room, Gina. That was a great experience. And in fact, just recently, I was in Irving, Texas for the PCAOB Small Business Broker Dealer Forum that I had an opportunity to spend time with an IAG member discussing the work of the PCAOB and advancing investor protection. Gary, it was a great time in Dallas. You know, thank you for your hospitality. Those types of engagements are extraordinarily valuable because they provide insight regarding investor perspectives and priorities. As I have suggested before, I believe that the board makes the best decisions when it is informed by an array of perspectives, being keenly aware that investors are not a monolithic group. Let me note an obvious matter that is at the forefront, I'm sure, of many minds in the room. The PCAOB is in a period of transition. I sincerely hope, however, that the Investor Advisory Group will endure and that its efforts to inform, as George talked about the history, it should be a thread through the fabric of the PCAOB moving forward. And that PCAOB projects will not be interrupted by a transition. In passing the Sarbanes-Oxley Act, Congress seemed to suggest that the board would benefit from the wisdom of external professionals as such. Sarbanes-Oxley specifically authorizes the board to convene expert advisory groups. Over the past few years, we have regularly organized these gatherings. Indeed, this is the 9th IAG meeting convened since the group was relaunched, reestablished in 2022. Each meeting has enabled the board to deepen its knowledge and awareness of current issues and investor concerns. For example, earlier this year, the IAG presented to the board on opportunities and challenges of artificial intelligence. And last fall, the board heard about emerging issues associated with audit firm ownership structures and funding arrangements. These topics remain top of mind for many in the audit profession. I am grateful that current and past IAG members have volunteered their time to conduct research, engage in dialogue, write comment letters, and educate the public about the role of the PCAOB in promoting investor interests. I believe that investors are better served when they have a designated forum to make recommendations to the board. And as such, let me thank all of you for serving on the IAG. I look forward to hearing about the topics that will be covered during today's meeting. And in closing, there's many people that make up all this work. I would like to thank our Office of Chief Auditor, our Division of Registration Inspections, and our Office of Communications and Engagement, and of course, Saba and her team, the Office of Investor Advocate, for their dedication to the PCAOB's mission and their contributions to organizing this event. Thank you.
Thank you, Board Member Tony, and thank you to all the other board members and acting Chairman Boric, we'll now open it up for questions. This is your opportunity to ask questions.
I don't really have I don't really have I don't really have a question, but I do have a comment that sort of stems from what Board Member Thompson just said with respect to the PCAOB being in a state of transition. I think that's true, and I think that I, as representing an investor organization, worry is that the pendulum keeps swinging one way to the other, and that we need to reduce the degree of that swing. I don't think that we can eliminate that, but I think we need to reduce the degree of that swing. I think that the conversations with respect to the PCAOB and the challenge to the PCAOB in Congress have provided a really good opportunity for investors to highlight to the House and to the Senate how important the PCAOB is to investors, surprisingly so to some. And I think it's also a great learning experience with respect to that political narratives rather than facts with respect to how the PCAOB is funded and the like really needed some clarification and some true understanding because reducing the PCAOB's budget does not reduce the federal deficit, right? So we learned a lot of staff members did not understand that, right? And so, but I think as we go forward, as I think about it, is that from an investor perspective, and I think also from those who are regulated, that the stakeholders to the PCAOB have an obligation to identify how the PCAOB, in their view, and the PCAOB should, in their own view, be measured from both an efficiency and an effectiveness perspective. Because comparing the PCAOB budget to the SEC budget, particularly since we're analysts, is really an uncomparable, and it's not a relevant analysis, right? But I think in the four main, if we would call them, if we were looking at a business operating segments of the PCAOB, I think it's important to develop efficiency and effectiveness measures so that we cannot have Congress focus on PCAOB board members' salaries, that they should focus on what, in fact, the PCAOB's particular mission is and whether or not it's accomplishing what the investors who are meant to serve it in particular are asking for. And I think the Investor Advisory Group has an important job to do in helping define and set those. And we need actually a little more transparency from the PCAOB to actually do that. So not a question, but a comment.
Thank you, Sandy. Ken, I see. Yeah, you just have to.
Okay. Three very quick comments. One is been involved with this organization now a couple of years. My second time, and I just want to say I've really appreciated it. I think the work over the 20 years has been very, very good. So I really appreciate the efforts of the group. Two is, and I've made this comment previously, as I look at the enforcement actions, I think many times they're disproportionately to some of the smaller firms. And I do think we have to think about how we educate and help those firms do their work or adjust some of our standards to their work and or realize some of these firms probably can't exist in the world we live in today. Three, we're going to talk about evaluations of private companies. And I just make a comment, I'm on actually 4 public boards. One just went public today, longtime CFO. And the thing I've noticed is, this is all public, we've gone from some like 8,000 public companies to around 4,000, I've seen different numbers. As you go through it over the years, your 10Qs now are 100 pages plus. They used to be 40 or 50. The amount of work now for the proxy is 3x what it used to be. And so as I know we and the SEC thinks about how to get more companies public, I think in the, and now there's a talk about, quarterly versus semi-annual reporting. I think that it doesn't really hit the issue. I think the issue really is the amount of documentation work it takes to do the quarterly reporting, the annual reporting, both in terms of the normal SEC filings as well as the proxy filings, which have, if you look at over 20 years, have probably tripled the number of pages that are provided. So I think over the time, I'd like to see this organization take a look at what are we requiring public companies to report on, and is that one of the reasons why so many companies today are staying private and so many companies that are public are going private? Thank you.
Thank you, Ken. Anyone else? Yep, Nemeth.
I'd just like to make a brief comment saying, I appreciate everything that the PCAOB has done and is doing to improve audit quality. And I say this, that there's not enough attention being paid to the idea that there hasn't been a major fraud since Enron and WorldCom. And I think the absence of such a big fraud should not let us lose sight of the important work of that the PCAOB is doing. The incentives to commit fraud have not changed. They still exist, and we see this to some degree in the private markets that are not regulated by the PCAOB. And I just want to highlight that. I think that is important, that the PCAOB continued streak, and we remind people about the importance of what the PCAOB does.
Thank you, Nemeth.
Just by way of follow-up, I think there's sort of an unfortunate irony embedded in the institutional mission of the PCAOB, which is the better you do your job, the more likely it is to be taken for granted. You're not going to get credit for the disasters that haven't occurred. And I understand the burdens of fulsome reporting have increased dramatically, but how much of that is due to non-GAAP financial reporting, which is a great amount of that, which I don't have anything against. But one of the reasons I don't is because I know I can depend on the PCAOB and other regulators to make sure that that information, both GAAP and non-GAAP, is presented in a way that is objective, factual, and ultimately useful, credible. Thank you.
And I will piggyback that I do think that it underscores Board Member Ho's comment that this is not only about creating regulation that is proportional and focused on materiality, but that we focus on innovation all around, because I think the needs do become greater as we become complacent. But the desire and the necessity really to accomplish these things is not going away. But what is changing is the ability to innovate into these problems in order to accomplish more. And that is the promise of innovation, is productivity, doing more with less. And I do think that we have to also think about that ecosystem and how we foster it to solve the ultimate mission that we're trying to solve, and hopefully do it in a cost-effective way.
Thank you, Gina. I don't see any other hands up. So we are running a few minutes early. Next on the agenda is the IAG's presentation on private markets valuation, a timely and critical topic given today's evolving economic landscape and the growing complexities in financial reporting. So IAG members Amy McGarity and Gary Walsh will moderate the session and introduce our distinguished panel of presenters.
Thanks, Saba. I think our distinguished panelists are getting settled right now, so we'll give them a moment. But speaking of innovation, thanks, Gina, for that amazing tee-up for this topic. This came out, I thought it was a great idea. There were other members of the IAG who suggested it as a topic because there is increasing interest in allowing more broad access to private markets via retail, daily traded, et cetera, types of vehicles. And as we think about the risks to investors, I think valuation in non-public areas of the market that allow daily or frequent trading is a risk for investors. And so the objective of this panel is really to educate the board as well as the IAG on the existing ecosystem, sort of how the market's changing. We have an incredible panel of experts ranging from general partners who have been doing this for years to a general partner who's considering doing it and looking to hopefully get into this market more readily. We have an audit expert on the panel who will share her insights into what they're doing to provide assurance for boards and investors, as well as an expert in valuation. So I can be more excited about this panel and honored to have them in our midst to share their expert knowledge with us. So Gary and I have some questions we've prepared and shared with the panelists, but I thought maybe it would be helpful to turn it over to them for a brief introduction of themselves, what they do, where they fit into the ecosystem of this topic. And I think I'll start with Paul.
Thanks, Amy. Appreciate it. So, hi, I'm Paul Quinlan. I work at Blackstone. We're an investment manager. We're the largest alternative private markets investment manager with businesses across private equity, private real estate, private credit, et cetera. I've been with the firm for 15 years. I'm currently COO for our defined contribution platform. Previously, I spent more than 10 years as CFO for our global real estate business. Thanks for having me today.
Thanks, everyone, for having me. I'm Megan Kilcourse. I'm a managing director and co-head of fund accounting operations at Warburg Pincus, a global private equity firm based in New York. I've been at the firm for over 16 years, and I started my career at Deloitte in their audit group. I'm, in addition to my co-head of fund accounting operations role, I'm also involved in our entry into the retail space.
Thank you for having me. I am Katie King. I'm an audit partner at PricewaterhouseCoopers. I spent most of my time in the asset and wealth management space, serving various clients from mutual funds to alternative funds. And I also lead up a lot of our efforts from an industry perspective in relation to regulatory items that come up. So, for example, like 2A5.
Good morning, everyone. Great to see some familiar faces and some new faces. My name is Brian Garfield, and I head up Lincoln International's U.S. portfolio valuation practice. Lincoln International is a global investment banking and advisory firm. In our valuations practice that I oversee, we'll actually value about 25,000 portfolio companies this year, all of which are privately held. We're working with over 200 different alternative asset managers. They focus on private equity, private credit, infrastructure, really the whole gamut of the alternative space. And what's really interesting is we've seen a large volume and increase in the frequency required for valuations. In fact, 30% of what we're doing today is actually valued more frequently than quarterly. So looking forward to a very fruitful and timely discussion today.
That's great. Thank you. And just to set the stage on the format, like I mentioned, Gary and I have some formal questions that I think will give us some insights into the evolution of this space. But I would open it up to anyone at the table to ask questions, as it is designed to be educational. I've promised our panelists that it's a friendly group, so I don't think it's going to be a contentious discussion. It's really just to get into it, because as an investor, I don't know what's happening. And if I don't, and I'm a large institutional investor, I think we can all benefit from more information. So I'm really just grateful. So thanks for being here. I'll just kick it off with a broad question. I'll throw it out to anyone, but it's definitely relevant to Brian. Retail investors are increasingly gaining access to private markets, often through semi-liquid or interval funds. From your perspective, what are the unique audit and valuation challenges that emerge when private assets are linked to daily or frequent liquidity?
I think I got the plug in the beginning of the question. So happy to kick things off. So look, I think what's really key about the launch of semi-liquid products, the first is to say that while we're seeing a lot in the press more recently, there's been many valuations going on more frequently than quarterly for some time now. as assets that were maybe once public go private, and there's a requirement to have to produce more frequent valuations. So actually at Lincoln, we've been performing valuations on as frequently as daily for well over a decade. The second point that I think is quite relevant here is when you think about methodologies for valuation, and you could look at any textbook, go to any course, look at what the work that we do. When you look at the valuation that's done on a daily basis or a monthly basis, what you will find is that those methodologies are the exact same as those that are being performed on a quarterly basis. So if you're valuing a private asset, you're going to try to maximize the number of valuation methodologies that you utilize. And some of the frequent methodologies, for example, if you're valuing a private equity investment, would include an income approach, a market approach, pronged into what folks like to refer to as a selected public company analysis and a precedent transaction analysis. All of those are incredibly relevant. And what's happening as we go to the semi-liquid product is that the speed of execution is what's changing. So what's really critical, and it was discussed in some of the remarks earlier, is that you have the right systems in place to be able to handle the speed in effectuating a well-rounded and well-supported valuation. So again, it's not necessarily methods that are changing, because those are going to remain the same. It's just the execution process that's going to be accelerated, and having a strong execution process is really going to be critical to a successful semi-liquid product.
Yeah, and I'm happy to chime in. I agree with everything Brian said. We've spent a lot of time on execution. I'll get there in a minute. Maybe just zooming out for a second, though, for why kind of private markets are an important part of a portfolio. I think one of the board members mentioned earlier, the number of public companies has reduced from 8,000 to 4,000. 90% of scaled private companies in real estate in the US is private. So if you're not investing in the private markets, you're missing out on a very big piece of the investable universe. So we think it's an important part of a portfolio. We started our journey in offering private markets to individuals in 2017, and we had a few areas of focus. One was customer experience. So our products generally have 1099s rather than K1, so it's much simpler on a tax reporting basis. 2, education. We launched broad education programs for advisors that are advising clients whether or not to invest in these products. We call it Blackstone University, full-day courses, et cetera. And then 3, valuation was very important. We wanted timely valuations and frequent valuations. So we set up a monthly valuation process. Obviously, that was challenging. As the CFO of our real estate business, I spent a lot of time there. I'd say, how did we deal with that? One, we have the same rigorous approach and took the same rigorous approach every month that we took every quarter. 2, we heavily leveraged technology. There's technologies out there like iLevel 73 strings where we automated big parts of the process. And then 3, we needed people and platforms. We have a very large, when I left the real estate business, I had as many people working on my team in India as I did in other parts of the world. And so we had a 24/7 operation that allowed us to run DCFs for thousands of assets, thousands of companies on a monthly basis, and strike a rigorous NAV that then went through a rigorous third-party review process.
I think one of the areas too that we see that continues to be challenges in this space, although I agree with what Brian was saying, we do see this starting to get a little bit more transparency, is just data. So data in this space is which is nothing new when we kind of see innovation and what we're thinking about from an asset wealth management perspective, but it's more in the availability, the frequency of the availability, and the reliability of the information. So that's one of the areas that we see that when asset managers are going into this space, it's something to really focus on to make sure that they have the ability to validate what's coming through and they're getting it on a frequent enough basis to be able to support their valuation methodologies. All of this is really underpinned with having the right people in the right seats who have that experience in order to help them assess the information when it comes in and thinking about how that impacts the valuation of the private assets. One of the areas I know we've talked about it, even when we were having kind of our prep session, is we see some challenges a little bit differently depending on if you're a traditional mutual fund shop and you were built around the regulatory world and you know how that space works and you're building out private assets, your challenges are a little bit different than coming from a pure alternative shop building out regulatory products for the first time. So we'll see that in areas such as valuation. We'll see that in areas such as compliance, and how you kind of build out your regulatory strength around what you're seeing for particular vehicles that you're building out.
Just really quickly, a technical ask is when you're done speaking, if you could just push the button again. I guess we're probably having some challenges online with multiple mics open, but Megan, I'm going to put you on the spot because Katie just said something that made me think you might have an interesting, unique perspective in that you are getting ready to launch a semi-liquid fund, and what unique things are different in terms of your traditional business and this new line of business in terms of audit and valuation?
Yeah, thanks for the question, Amy. So definitely echo what Katie just mentioned. It is going from just making sure that you have more compliance, more regulations and a broader compliance program supporting your new reporting requirements. So that's something we're spending a lot of time on. I also think board member Ho said it well before when it was figure out how you can automate the checkbox, the check the box activities. So automating getting the data from the underlying portfolio companies, automating the inputs into your valuation models so that you have more time to spend on the judgment calls, on looking at, how are we going to change from going from a quarterly valuation process to more frequent. That's going to be new for us and is something we're actively working on taking on, which I'm sure you went through a few years ago at Blackstone, but we're prepared for the challenge.
Yeah, it's not easy. One thing that I would mention is for these types of products, I'll speak to our products, they generally have public company financial statements, public company style financial statements, 10Qs, 10Ks on the SEC website. So there's quite a lot of transparency. Those are audited by a Big Four audit firm. So the level of transparency for these vehicles is quite extensive.
I think one of the things that's also critical to some of the changes that need to take place is oftentimes a manager will say, hey, how can we be most successful when we're thinking about these products? And one of the answers I'll always say is, if you were to start today and knowing what your fastest frequency of valuation is, how would you set up your program? Those that take the approach of reimagining their process, not about how is it today to then conform to what it needs to be, but rather thinking more directly as what should it be given the new world that I'm living in, and let everything operate off of the highest frequency reporting production, highest frequency evaluation production. Those tend to be the most successful, at least in my view, because they're really thinking about it in that lens, as opposed to trying to take what is a historical quarterly process and jam in a daily or a monthly reporting process.
Given what we've talked about, how has the changing nature of the participants going from institutions more towards retail changed the way that that you're equipped to provide NAVs and valuations?
Yeah, I can start. I think the key for us was looking at a process where if you looked at your drawdown fund structure, 15 years ago, you did quarterly evaluations. They were typically produced on a 45 to 60-day lag, and there wasn't trading on those valuations. So kind of the stakes were lower in some respect, whereas now we're calculating a trading NAV every single month. We've always had a rigorous process. I'd say we did some things a little bit differently when we went to the monthly process. I'd say one, we increased our staffing. Two, we increased our focus and implementation of technology. But importantly, we also added additional third-party reviews. And I say there's 3 layers of that. One, there's firms like Brian's at Lincoln that provide positive assurance for all of our valuations that they're reasonable on either a monthly or quarterly basis, depending on the vehicle for all of our assets. Two, our assets in our vehicles are often Most of our vehicles are subject to an appraisal once per year by a different third-party expert. And then 3, our auditors, and most of these vehicles are fair value vehicles, and I'd say our auditors spend more than 50% of their time on the audit focused on valuations. So we think the robustness of that process externally, on top of our internal process, which includes several kind of committee reviews and whatnot, really brings a level of accuracy and sort of to our NAV that's quite robust.
I see we have several questions around the room. I think this is probably a good opportunity. Sandy Peters will go you, and then Gina Sanchez, and then Sandy Rich.
So this follows up on my question occurred to me when you made the comment that some of these are financial statements are public financial statements, because the challenge that we have is that there are different accounting requirements and disclosure requirements for non-public companies, right? The FASB has created all kinds of alternatives where they don't have to, they can amortize goodwill, they don't have to make certain disclosures, and they're actually audited under different auditing standards, right? So the challenge is that going from private companies going to the public market, retail public markets, is really a way for companies to circumvent, in some people's view, the entirety of the SEC's disclosure regime. Not the entirety of it, like it's a different disclosure regime on the fund, right? And so, part of the challenge that we have is that there are presumptions made in the value in the accounting for private companies that, oh, well, investors have greater access to management. Well, that will be less and less of the case, right? And so, and they don't do fair values as often, so they can't do stock-based compensation or goodwill impairment, right? So it's kind of, when we look at it and say, well, are we agreeing to an entire shift of moving back to private company accounting and still getting to the public markets, right? There's a concern that we have that we're actually making it even more disadvantageous for companies to go directly and register as the public market. I don't know what you guys see in the context of the underlying information and how it's prepared for private companies, and the auditing standards are different. And that's what I'm trying to work that through the system in the sense of how important I should think about is that.
Yeah, I mean, I've been the CFO for our public mortgage REIT as well. I'm very involved in our public company reporting. I'd say the reporting is actually quite similar for these vehicles than it is for public companies. So I would encourage, the group to spend time kind of looking at the two. I don't think the difference is, I can't think of anything that's like overly material. Obviously, the bigger differences are in how we, what is the investor base? It's more, individual investors versus perhaps a mix of individual and institutions and public companies, and then how we face the markets. Public companies have, quarterly earnings calls. They have analysts that cover them. So there are differences, but I'd say on the accounting front, it's much more similar than it is different. So I think, taking some time looking at those sort of areas is probably a worthwhile exercise.
Gina, go ahead.
Thank you. Sandy, thank you for that. That was on my mind as I was going through the mechanics of thinking about it. I think my question might be to you, Paul, or anybody who wants to answer it. Obviously, there is a difference in disclosure requirements. And when you think about the business of making these investments on behalf of others, you generally, as an analyst, require on those disclosure requirements, on timing and on transparency. And to the extent that you can achieve those and achieve the transparency necessary to say this is how this differs from the current a comparable public company, I think that we can theoretically get there. I think one of the things that I'd like to think about is the degree to which this offers an opportunity to reimagine the technology landscape and how we can move from, if you think about how SEC reporting started, it started in paper form. That paper form used to then get digitized. Then we went to PDFs. And the reality is that most companies now that are issuing either in the venture or in the private equity space are actually issuing their information onto platforms with direct connectivity into their accounting systems, such that you don't get the same kind of error types that we used to get. You have Carta, you have Standard Metrics, you have others that could potentially offer that sort of transparency that I think the market needs in order to properly price and value securities. And ultimately, the secondary markets and continuation vehicles are emerging as kind of a way to effectively create that valuation voting mechanism that is the public markets. And I wonder to what degree you think about this opportunity as an opportunity to reimagine the technology landscape we live in and how we can create a better process that doesn't begin with paper. Any of you? I mean, I just know that Blackstone is a big user of technology, but I'm happy to hear from anyone on the panel.
Yeah, maybe I can talk a little bit about what we're seeing more broadly as we think about these assets coming into some of our client bases and how they're thinking about it and how we're thinking about it. There's definitely an opportunity to use technology. A lot of when you think about the valuation of what's coming underneath these type of private companies or private credit, it's still coming through, into your point, paper. We're still seeing marketing materials. We're still seeing materials that are, PDFs. It could be all different versions of different types. And what we're seeing is people employing different technology in order to, one, collate that information and do it quickly. So how are they pulling that information quickly from the private companies, from the private credit shops? And then how are they overlaying that with things like tools such as AI or OCRs, where they could be able to look at that, read through the documents quickly, train it on what you want it to look for, and have it pull in that information, kind of help expedite when you're thinking about, when I'm looking at my valuation review, when I have to do it on a daily or weekly basis. All of this, of course, comes with the importance of the human users, which means it has to be trained appropriately. You have to have somebody who understands what they're looking at so that when the information comes out, does that make sense and does it align with your expectation? But to directly answer your question, yes, technology plays a really big role in this space in order to expedite the pricing, valuation, what you need to do to strike your NAV for products like this.
Yeah, and I'll add, I agree with Katie, and we focused a lot on our technology. I'd say your question, was focused more on maybe investor-facing technology, but to Katie's point, the key here we think is data quality, and so we've really focused on building the foundation. We use a tool called iLevel, which allows us to kind of take cash flows from the source and put it in the cloud for use in our valuation process. We've recently engaged with a firm called 73 Strings, which has kind of gone to the next level, is more AI focused, is more pushing that automation data quality agenda, getting cash flows to near 100% accuracy, because that's really, that quality of data is fundamental to everything. So I think as I speak to peers of ours in the industry too, they're on very similar journeys as well. So, having started in the private markets 15 years ago and seeing the evolution and maturity of the industry over time, I think Brian mentioned it earlier as well, it really has, moved by leaps and bounds, and I expect the next 10 years to be no different.
Yeah, there's really not a conversation that I'm having with any asset manager. Every single one of them is having the same conversation about how can you leverage and utilize technology tools in the process. And to Paul's point, I think a key to this is really about getting harmonization and standardization of the information that's coming from various different reporting systems, putting it in an environment. So what we will do is take all of what I like to call unstructured data, structure that data using tools, and then reporting that information back to the asset manager so they can ingest that information and create information for their valuation committee, for their audit review, for any reporting that they need. And that's a very, very common trend. What we have seen is that many asset managers also are moving away from the production of 15-page PDF reports. Because you take 15 pages, you multiply that by 200 assets, all of a sudden you got a lot of pages. And what's really in that really drives the valuation is what folks are looking to extract. And we're seeing that in action, and that's been in action for some time. Again, I go back to just the point that it's important to stay in the game. You have to be investing in technology, something Lincoln's doing heavily. We have tools ourselves that are proprietary that we use, and then we're pushing information to our clients, and pretty much every one of our clients is using some kind of tool, some way. And a lot of the tool functionality is not so much on how do I get the tool to do valuations for me. It's more about how do I get the information into the tool so I can make decisions on what I want to mark these assets over.
I'm just going to take a little bit of moderator privilege and ask a question, even though I see all the hands up around the table, because it really does lend to this question. Also goes into the second question that I had in the written questions, and I'm going to direct it at Katie, because as we talk about technology, Paul, you mentioned potentially using even some AI tools in order to gain inputs to help craft valuation. Maybe that's just what I heard, but what I'm thinking is, as you're valuing these private companies, you have publicly traded comps, you have all sorts of different ways to value companies. But as an auditor, you're probably looking at the process, and to the extent that some of these tools may be a little bit opaque, are they, or is it really transparent from your perspective? And how does technology become transparent how do investors have comfort that the auditor has transparency into these black boxes?
Yeah, I mean, I think I don't really see them as black boxes in my experience. Yeah, so I mean, I think we see the way we see our clients approaching this is there's various different methodologies that they're utilizing, because when you think about this, you really have to kind of chop it up by asset class. So I know we're talking about private assets overall, but it could be credit, it could be equity, there could be real estate, and each of those have varying degrees of information you're going to be able to get, frequency. And quite frankly, some of them probably aren't going to move very often. So it's depending on what the type of asset class, how you build out your processes. That's where the policies and procedures come into play. That's what I'm looking for when I go in to talk to my clients. What are your policies and procedures? How have you put them together? How do you deal with market movements? When you're looking at different countries, for example, how are you dealing with looking at inflation, interest rates? How are those impacting specific things? It's all the different aspects of what goes into making the valuation. We want to make sure that our clients are thinking about them and thinking about them at the right frequency, and having either tools in place to be able to do that. Or, some of our clients, still have a lot of interplay with their portfolio managers, which is fine. The portfolio managers have a lot of insight into what's going on, but then you overlay that with the importance of the valuation committee. The valuation committee in a lot of these instances is extremely important, in having different voices from different aspects of the business coming into those valuation committees to speak about what they're seeing and to ask questions. So it's not just one overriding voice in the meeting, it's pushing on it, making sure you have the right market, making sure you have the right support in there. Those are the type of things that I'm looking for when I'm going in to kind of audit through what our clients are doing. And quite frankly, a lot of the time, when we're going in, we're getting their full on pricing methodology from start to finish with all of the data inputs that we're looking at. So it's not a black box. We understand what's going into it. We understand what they're doing and why they're doing it.
We're going to have Saba pull the meeting notes from the PCAOB meeting 20 years ago when Excel first came out, because I think what we will be hearing are very similar questions. And I think if you kind of think about, Excel for a second, and if you were to go ask me and every panelist if we have the same exact model in that tool to do an income approach, a market approach, or any type of technical analysis, the answer would be, Well, we're following the same principles, we're following the same like academic structure, but they don't look the same. They all look different. And I think that's what's going to make this work, quite frankly, is that, you know, we're going to be using slightly different derivations of different tools. They're going to kind of cross function, you know, look at each other like we have right now. And I think that that's what's going to make the world kind of harmonize. We're just in a state right now where we're in a state where we're evaluating what tools are superior relative to others in this technological landscape. That's definitely what we're going through right now. But we're going to have more than one tool, and that tool is going to be leveraged by people in different ways, even if it's that same tool, the exact same way that Excel is right now.
Paul, I saw you reach for the mic. Did you have anything to add? Okay, no. Sandy Rich, you're up. Then we'll go Nemeth, and then we'll start over there.
Thank you, Amy. Before I ask my question, I've been a non-investment grade credit markets trader, banker, and PM for many years. I now sit as a executive director of one of the New York City retirement systems. And as a trader, I knew the only thing you can actually really rely on is what someone will pay you for what you own. And I'd like you to opine on two observations. One is that if you watch the general partners publicly traded securities for the managers of these limited partnerships, there's been a significant diversion in valuations. One. Two, specifically for New York City, thank you, Blackstone, we did a $5 billion private equity secondaries liquidation. And if you are diligent enough and you want to actually get these facts, you would find out that we got paid 62 cents on the dollar net of a 7.5% fee. So we got paid 62 and we paid a fee of 7.5, and someone paid us basically 70 cents on the dollar. That was calculated on NAVs that had marked down over the years and was set basically within a month or two of the transaction pricing. Some of those trades have yet to settle, but 60 cents on a dollar. So that suggests that there may be weaknesses in the publicly disclosed NAVs used by large institutions such as us who are audited, rely on outside auditors, and rely on the valuations being provided to them. So I'd just like to have your thoughts about that, because that does suggest that while the technology is great about establishing NAVs, they cannot be relied on for liquidations. And with the growing surge in secondary transactions, I'm wondering, do you look at those? Are your valuations being impacted by identified secondary market transactions, or the pricing of the GP who's managing these assets, who has them reflected on their balance sheet as general partners? Thank you.
Thanks, Sandy. So, and thank you for your partnership on that transaction with our firm. I'd say a couple of things that are distinct from the transaction that you described versus the vehicles we're talking about now. One, I expect that those were kind of drawdown fund structures with the less frequent valuations on a lag, things that we talked about earlier, versus these vehicles, which are monthly valuations, et cetera. One data point from our most seasoned vehicle in the individual investor space on the real estate side, over the last 3 years, we've sold 25 billion of assets from that period at a premium to the marks, to the valuations on our balance sheet premium. So above 100 cents on the dollar relative to the 62 cents. And then three, absolutely, we look at very granular private market comparables to each of the asset classes that we're invested in across our platform. And that informs our valuation. Our primary approach is fundamental DCF, as Brian kind of walked through, but absolutely we're looking at the market as well. And, typically our assets are marked sort of at a discount to what we see in the market. And so, again, I don't know the specifics of the transaction you reflected, but that's the way we think about it. And absolutely, we're striving for a trading value on our NAV.
I think one of the things that's important to address, just to put out there, is we need to also understand what the unit of account is for the valuation purposes, right? So when I was referring to the methodologies, effectively the unit that I was referring to for those is the underlying investments, let's call it the common equity in the portfolio company. When you do things at a portfolio level, like a portfolio level sale, there might be a different approach that would inform decision making in the process that a market participant would take in that level of a transaction. And so if you go back to the standard of value, if you go back to what the unit of account is, I think those are really important principles. All being said, all to say that you really need to take the market participant perspective in all these scenarios for the position that you're looking to value.
Can I just follow that up, Amy? So can't disagree with any of that. But as a manager of multi-billion dollars of PE exposure, we've seen significant declines in the distributed cash flows. I mean, I've got a question for later on when we get to kind of some macro overviews of the business. But that does suggest that people are having a hard time selling their assets, right? The reason I'm not getting distributions on my portfolio is because they don't see the value in the market for their asset to generate the cash to give to me. That also suggests that NAVs may be inflated. So, I mean, this is also just a generalized observation that something is happening in that market. It's the reason secondaries are exploding. It's the reason cash flows are down. It's the reason raising new funds has become more of a challenge. So I think that there's some questions to be answered about what has happened over the last 3 years, because our 3-year performance numbers are horrible compared to expectations. Sorry.
Yeah, I have a lot of questions with this too, but I think we might keep getting into it. So I'll defer. Nemit, please proceed with your question.
Thank you, Amy. I think my initial reaction was actually, I have a comment and a question. My initial reaction was very similar to what Sandy Peters had asked about just the inputs into valuation models, right? Because, I mean, my sample size is sort of limited, but like many of my students have their own companies, and when they've gone to raise capital from venture capitalists, they come to me. What they ask me questions about is how do they measure revenue, and here are certain options, and how do we, what do you think would be acceptable? Can we go with this or this alternative option? And I don't know if I've seen that standardization. I mean, I appreciate what I think Paul said earlier, that there is some standardization, but I haven't seen it even from people who are raising capital. And that is just, I mean, just basic ideas about what is revenue, what is cash flows, what is earnings. But from there are even other aspects that affect valuation. If you think of companies like, or the example of FTX, there were hidden risks, right, in terms of what conflicts of interest that the entrepreneurs had. And how does that come out in the private market when you don't have the disclosure requirements that public companies have? I mean, I don't know how does all this feed into valuation. The follow-up question to this is also that absent a secondary market transaction, how much faith do we have in a singular valuation number that goes into an NAV? Like for companies that are extremely intangible, heavy, high growth, like if we ask multiple valuation experts, are we going to get numbers that are somewhat close, or is it going to be all over the place? And if they're going to be all over the place, then how meaningful is a singular NAV number, or do you need a confidence interval around it?
Maybe I'll start. So thanks for the questions. I do think one thing to keep in mind is that these are assets that are, our companies have heavily diligenced prior to making their investment. So these are companies that, our teams spend a lot of time looking at the underlying metrics, the underlying financial statements, getting really detailed data from the companies that then we continue to get during our hold period. So we're really digging into, how did you get to this revenue number? Show me the backup. Show me all of the, information that went into that, which does give us a lot of confidence in the data that we continue to get. And we'll continue testing that and performing analytics to see year-over-year growth, quarter-over-quarter growth, and pushing on that a little bit. I'm sure Brian and Paul can comment on this as well, and I'm sure Katie too. Another important thing that many managers use in their valuation process is back testing. So it is, here's how I valued the company. Eventually, when I realized the company, how much did I realize for that, and how did that compare to my valuations over the few quarters before that, and why was I different? What happened? So sometimes it's the market changed or the company had a year of strong growth, and there are various things that could go into that, but that's an important part of any valuation process.
Yeah, I would just add, it sounds like you're talking about startup companies and crypto, and like the things we're investing in are generally mature, stabilized companies with a track record of cash flows. So like the cash flows, earnings metrics, EBITDA, those are like factual numbers. So we're really just trying to extrapolate those facts and kind of look forward to that versus a startup, which can be much more variable and much more speculative.
Paul, could we take your question now? Sure.
This has been a great discussion, by the way. I just wanted to first observe that I think we should ground this better in the idea that prices and values are not the same thing. It's even true in public markets, right? If a company has a market cap of X, that doesn't mean you can take it private at that market cap. You're probably going to have to pay a premium. So I think, and I think this is a communication obligation of asset managers, valuers, asset owners, to make sure that the public understands that a valuation and a price are two different things. And I think actually we're not really talking here about valuations and prices. We're talking about liquidity. Semi-liquid is an oxymoron. It's either liquid or it isn't. And so that would be my question, because I think this is the issue for the retail investor, for the individual investor is, can we offer them what looks like liquidity on an illiquid asset? What kind of options are we writing? Who is writing them, and who stands behind them? Because I know the folks that do the valuation are not the folks standing behind the valuation. Thanks.
I think part of that also comes into the vehicle in which you decide to launch. Like that is extremely important in thinking about what is your strategy, who are your investors you're going after, what do they want, what is the liquidity they need. So first, the decision is kind of what are you looking at? Are you looking at a BDC? Are you looking at an interval fund? Are we talking about tender funds? So those types of funds and vehicles that we're seeing take off in the marketplace at this point in time and over the past couple of years have been very popular because I can give the less liquid, not semi-liquid, less liquid investments in there, but also overlay that with my ability to give some sort of liquidity. For example, in an interval fund where maybe there's opportunities where I have to take out lines of credit. So we see like financing coming more into play again. And then I structure my portfolio to ensure that because I've built out a structure with the entity or with the vehicle that I'm utilizing to say, I know this is the most I'm ever going to have to give from a liquidity perspective. So therefore, I structure either through financing or through other holdings in my investment structure to say that I'm going to have enough liquidity. So I plan for that. And that's what we see a lot of investment managers doing, is they're thinking about how do we plan out our portfolio to, one, get the performance I want, meet my shareholders' needs, but get the liquidity that I need. But because of the fact that it's actually built out within the confines of this, I call it the wrapper you put it in, it helps them kind of be able to manage that better.
Yeah, and maybe to put some specifics around it, our vehicles typically offer subscriptions on a monthly basis, redemptions on a quarterly basis. Those redemptions are capped at 3 to 5% of the overall fund NAV. That's very transparent on the way into the fund. But when we think about that 3 to 5%, we typically have something like 10% liquid traded assets as part of the portfolio alongside the private assets as one source of liquidity. Obviously, we have inflows as a second source of liquidity. And then to Katie's point, lines of credit. And we have teams that wake up every day just thinking about that and where we're going to produce that liquidity. But the important structural element to have the known cap at 3 to 5%. So we're sizing our liquidity for several quarters out that we have kind of in front of us to be able to satisfy that.
I think it's important to stress that that is something that's disclosed up front, something that is measured and and monitored really closely by the sponsor. Something we spend a lot of time on.
Great. Paul, did that answer your question?
Oh, no, it did. And that's all very good. It's just people don't read disclosures.
Actually, can I follow on? I think Paul makes an incredibly important point, and liquidity is an issue. I'm actually amazed at why any PE acquisition vehicle is a lockup vehicle when you could be a BDC or an ETF and leave the liquidity to the markets. I'm actually dumbfounded that that would be offered to retail otherwise. It doesn't make sense. Doesn't make sense. And there are, BDCs and have been around. I don't know, when was Ares created? 1987? There's precedent for this, and the liquidity is daily. It may not be at NAV, but liquidity has its value, significant value that we've experienced. Even though, thank you though, Blackstone.
Okay. Steve, let's go to your question. Thank you.
Thank you, Amy. And I agree. This has been a fascinating discussion. So thank you for that. So I've got a general, maybe less technical question for the accounting industry specifically. So it's probably for Katie here. How would you assess the readiness of the accounting firms to audit this significant growth of liquid valuations? And I'm coming at this more from a human capital perspective here, just having the right people on board to analyze, push back. It's a very defined and nuanced space. I think everyone's aware there have been challenges in the accounting industry in terms of bringing on new talent, retaining talent, especially junior talent. And there's a lot of competition for this competency, as the asset management firms themselves are building it up. So just more of a human capital talent management query. Thank you.
Thank you. So one, private assets aren't new broadly. So we have, from a firm perspective, and not just us, the big four firms and the audit firms in general, and accounting more broadly, when you're going into this space, this is new for the retail space, that they're kind of going into this and launching this. Alternative funds have existed for a very long time, and those assets that fall underneath them have existed for a long time, and we've had to audit those. So, from a human capital perspective, we have specialists within our firm that all they do is this valuation. I think I heard 50% of their time spending over. Some of our products, we spent over 75% of our audit fee alone, period, is on what we're doing for valuation on these private assets. And that may be a subset of mutual fund, because that's where we spend a lot of our time, because that's where the risk lies. And so having the right people, so we have people in that group that come, they're traders. They come from valuation shops. They come from all over the place, that they have that market information to be able to value these types of assets. And then, similar to what Brian talks about, we have methodologies that we apply, and we apply them consistently across different asset classes. So again, it comes down to the granularity of the asset class. And I'm not talking large asset classes like fixed income. Like we split that up to very granular asset class, and then there's varying degrees of methodologies we will apply that we believe that are appropriate to come up with what a reasonable valuation would be. So as an auditor, we have the opportunity to either one, understand your process and deep dive into that, and then also reevaluate that and reprice that. Or we can use our own methodologies to come up with what we think is a reasonable range of valuation to get comfort over the pricing that you've applied. So coming back to the question around having the right people to do that, we've built out, and similar to our peers, built out specialists to be able to go in, and they're partnering alongside our audit teams to really go in and deep dive into the valuations, similar to what I'm sure you see kind of on Brian's side.
Ken, why don't we take your question next, and then we'll go to Stephen Gray.
I'm going to actually follow up on some things I heard Sandy say. I have a long history not as a CFO, not only as a CFO, but invested in a lot of venture-backed private equity real estate funds, and they're quite different. If you think about venture-backed, most, the reality is most of them use marks that they look at the last time they did an offering of one form or another in terms of raising money. They don't really do a mark to mark as you suggest. Common versus preferred equity are also marked very differently. Many of us in common use an IRS promulgation called 409A. I'd like you to comment on how you see common versus preferred, how you see venture-backed, how you see private equity valuations. Comment on, Sandy, on secondaries. What I have seen in a number of secondaries, the challenge there is the marks are based upon, a lot of times, the buyer of the secondary, and they're looking at what they need to make their IRR. So they purposely discount, and it is what it is in terms of valuations. So that you can't necessarily look at those as real valuations either, unfortunately. Then the last point is there's a lot of discussion about 401k funds going in for small investors, whatever, into these areas, and I question how well that's going to work because these aren't liquid marks or companies, and the marks are going to be very, I could easily see some people complaining down the road that I bought in at an inflated price, and so therefore I took a loss, and therefore you're now at risk. And so I don't know if you want to talk about. I know it's more of a more political almost thing as to how you think about 401ks investing in non-accredited investors investing in non-liquid investments. So that's the sort of comments and questions.
I could try to hit that first one. So you mentioned kind of venture back. So from our experience, first off, thank you for your questions. We greatly appreciate it. On the venture side, what we do see first off, from a practitioner's point of view, there is a guide that is out there to follow. What I think is great about having guidance is that you should see conformity in the approaches that are being taken by having a guide in place. And that guide speaks specifically to how to handle different rights and preferences for preferred and common instruments. And I know that, for example, the audit firms are using that as a tool themselves, because when we are receiving questions, they'll say, in accordance with the private equity venture capital guide, blankety blank section, can you please explain why you did or did not utilize this recommendation? And so I think having a tool like that is incredibly helpful. When we do the valuations on a venture-backed deal, I do think it's important to start with that last round of financing because it marks the point in time where there was an arm's length transaction between a willing buyer and willing seller. And so it acts as a stake in the ground for us to anchor the valuation off of, because it's so long that it was a willing buyer in an orderly transaction. And so from that point forward, you need to understand, okay, well, what's happening with the company? And again, take the perspective of the market participant. What information do I have that's available in the public domain? What information am I getting from the company based off the right that I have to that instrument? So information rights plays a key role in your ability to properly value a common instrument versus a preferred instrument. If you're just in a junior minority position, you're going to have far less information than if you are a controlling shareholder. So that's all going to play into the cards from a valuation perspective. And then I mentioned this, but just to reiterate, the rights that a preferred shareholder would have, they might be a convertible preferred, they might be a straight preferred instrument with some type of return that is priming the common instrument. Oftentimes you'll find yourselves in a situation where those two might not have the same value unless there is a triggering event like an IPO where there will be conversion feature kicking in. So long-winded way of saying that, I think the fact that there is a guide out there is really helpful. It sets a consistent framework for how to approach these scenarios. And to your point on the 409A, I think what's important about the 409A is that's being prepared for stock compensation purposes. And there's going to be certain discounts that also come into effect there. They may not come into effect when doing other valuations for other similar units. So again, all these are relevant points kind of when considering a venture capital valuation.
And I'm happy to hit on your question on 401k. I'm actually now helping to build out our defined contribution platform. I'd say a couple of ways that we're thinking about that. One, we're focusing on our perpetual semi-liquid funds, which strike NAV on a monthly basis. Two, we're not intending to have those funds available for an individual, John Smith, to go on his 401k and to pick 100% allocation to private equity. We're anticipating that we are offering our funds in an asset allocation fund. So whether that's a target date fund or a managed account, where a minority of the assets are private markets, 10, 15, 20% kind of at most. And that allocation provides significant benefits looking back, strong performance, lower volatility over time, and importantly, diversification, non-correlation with the remainder, the 80-90% of the portfolio that are in public equities and public fixed income. So we're kind of entering into this business similar to how we had addressed the retail space, really thinking about customer experience and making sure that we're doing things in a highly responsible way. On the valuation front, it's much easier to create a daily valuation, kind of interpolating between two 30-day points where you're running a full valuation process. But the other thing that we're doing is working with asset managers to, at the fund level, limit their significant purchases or sales to period end when we have a struck and reviewed trading map.
Can I just make a very quick follow-up? You have to realize that it is what it is. Many times these valuations lag, because you mentioned on venture-backed, you look at the last round, I can guarantee you the 2021 rounds were very, very high. Yet I can also guarantee for the most part, many firms were very, very, very slow in changing their marks in 22 and 23.
Great, thank you. We'll go Stephen Gray, and then we have an online question from Jonathan Grable, and then Satyam.
Just starting where, pardon me, Brian commented earlier about harmonizing the information and perhaps distilling it. Thinking about that in terms of the nature of the assets and the ultimate nature of the constituency, the retail investor, you're assembling an enormous amount of information on private assets that ultimately, because of all the work that you have to do, I don't know how much additional effort would be required to share that information. Fundamentally, if it's unique because you're dealing with private assets, you don't have to worry about an active investor taking the other side of the trade. And so there's, on the one hand, no disincentive from that perspective in terms of your holdings. And then on the other hand, you could say, well, because we know a lot of retail investors are going to be investing in these, are going to wind up holding them, we have maybe a heightened obligation for disclosure. And that may result in 500, 5,000, 20-page PDFs. And certainly nobody is under the obligation to read them. And retail investors may not be reading the disclosures anyway. But at least they have the opportunity. And those advising them, could argue, have a tacit obligation to at least look at that information. And as you've all explained, you're assembling all of this information now. And online real estate is infinite. There would be no real impediment to putting these PDFs up on a server somewhere where somebody who's interested in the fund could see the underlying investments and say the 5-year look back, the 5-year projection, the discount rate applied, basic summary, not too much information, but enough to be able to make an informed decision. And then as the technology that we've all been talking about accelerates in adoption, assessing and evaluating that information will only become easier for the end users. And that would be, I think, somewhat of a solution for, I guess, the institutions on your side of the table in terms of your own credibility and assuaging some of the concerns that have been vocalized.
Was that just input, Stephen? There, I don't see any takers on any sort of line of question.
Well, I guess I could turn that last point around and say, well, what would be the impediments to doing that? Given that it's information that you're already generating, analysis you're already doing.
Yeah, I mean, I would say in our vehicles in this space, there's quite a lot of transparency on valuations, valuation inputs in terms of discount rates, exit multiples, things like that. Those are aggregated. I would argue that those are as meaningful as it would be if you information overload had 5,000 pages. That doesn't seem like reasonable for an individual investor to digest. And so I would encourage you to look at what's out there. And it to me, as someone who reads and rereads these documents, I feel like I have a good sense of how we're valuing our asset.
And I think one other point I should raise too is just because you're getting rid of PDFs doesn't mean that information is not being disseminated to the asset manager. All that was intended to say is that the format in which the information is being shared differently, but the actual content, substance that is there, is still landing in the hands of in a way to actually aggregate and ultimately, disseminate if that's the direction that this heads.
Yeah, I think that as far as the aggregation of the information, if it was disaggregated, there may be, I don't know, let's say 1,000 private investments, but of course we all know that the logical place to start would be the larger positions, and that would not be all 1,000 or 5,000 companies that you're invested in or vehicles that you're invested in.
Okay, I'm going to read Jonathan's question. Thank you for submitting it, Jonathan. Sorry that you're not here in person, but he really wanted to bring up the topic of non-GAAP accounting practices, specifically the use of EBITDA, adjusted EBITDA, modified adjusted EBITDA, et cetera, that many private companies use for valuation processes. He would like to ask the panel to discuss the implications of relying on non-GAAP accounting practices and would also consider it helpful to understand if this reliance should be a concern for us moving forward. I'm not sure who wants to take that one. Maybe Katie, maybe Megan, I'm not sure.
I'm happy to start. I do think, it's when you're looking at what input to use, you are looking at how would a buyer look at this company. So it is, we're supporting the fact that this is how a buyer would look at this company. They would make these adjustments, these non-GAAP adjustments, when they're looking at what this company is worth, because that's pretty standard in the market. That's how these companies are valued. And here's how we can point to other transactions that have happened that support that assumption.
The other thing I would just add to that, which I agree with, but I'll also add, is that there's two elements to determining the value. There's the EBITDA, the adjusted EBITDA that you're utilizing, and then there's the multiple that you actually select. And there's the evaluation of what the adjustments are, and also if those adjustments are coming down or if they're increasing. Based off those directional changes, then you go into what the multiple should be. And so if you're finding that the adjustments are not dissipating because synergies, for example, are not being realized, the action that we would take is to lower the multiple. So you're effectively, from a buyer's point of view, taking the position that you would not actually get full credit for those adjustments in an orderly transaction, and therefore you take a discount to the selected multiple. So I think there's two pieces to this. I would agree with you that we see adjustments, across private assets to try to, that are in both compliance certificates, in various reporting metrics. And I think the other flip side of that is, though, what's the ultimate selected multiple that you're taking, and what adjustments are you making to that multiple, downwards or upwards, based off of the observations of the realization of those adjustments?
Hopefully that helped, Jonathan, but if not, please text Saba again and we'll get you back in queue. Sandy, is this to this topic, or should we go to Satyam? Okay, go for it.
So Jonathan's question, which I think is brilliant, made me think of a question. So I've seen a lot of fairness opinions in mergers and acquisitions, and they, since '79 maybe was the first one I ever saw. Invariably, there is a huge spread between the choice of approach, and often you see a fairness opinion with 3 or 4 different valuation approaches. They use a EBITDA multiple, they use a revenue multiple depending on the industry, they use a market cap comparables, they use a DCF. I can't think of any others, John, but I've seen those. I'm wondering from Brian, do you apply different valuation metrics to each one of your valuations and choose? And then to Katie, do you have transparency to their inside analysis, which might be, we value these on this criteria, those on this criteria? I mean, I'm just kind of trying to look behind the curtain.
Yeah, so generally what we want to do is try to maximize the number of approaches, because they all have some advantages and some disadvantages. So the more approaches you use, that allows you to somewhat harmonize, triangulate the answer. So if you think of a DCF, you're looking at cash flows over a longer dated period of time, 5 years in a discrete period, and then a capitalized or an exit multiple in the terminal period. That's a different methodology than when you're looking at a market approach and you're taking an EBITDA for the current period and the next calendar year and ascribing a multiple to that. One is looking at core financial information of the business all the way down to the cash flows, the free cash flow of the company. The other is looking at the earnings profile of the business and a multiple selected. So from our point of view, we really want to try to maximize the number of approaches. I think some of the key inputs that go into that are, what is the comparable companies you're ultimately utilizing? If you have a poor comp set, that's going to be challenging. You're going to have a challenging time ultimately coming up to an answer that's reasonable. So you got to spend a lot of time with the selected public companies. To the extent you have private transactions and private data that you can utilize to help triangulate a conclusion, that's another thing that we will do based off our proprietary private company database. And you also want to look at industry metrics. So for example, if you're valuing a software business, looking at various software metrics incremental to the other standard methodologies would be important. So things like Rule of 40, looking at recurring revenue metrics and others like that are quite critical. Again, ultimately, I would say my underlying answer to that is the more approaches that you use, the more angles that you take, the more that you pressure test those assumptions, the more reasonable the answer ultimately, you'll ultimately get to.
I would also add on to that, we also see from a back testing perspective, that's where it becomes extremely important, back testing all of the inputs and assessments that you're utilizing. And we see that as something that clients are definitely doing, particularly in relation to 2A5, that they have to go back and make sure that they understand the inputs. From an auditor's perspective, we get full transparency into kind of how our clients are doing their valuation. So that goes from, even I still get spreadsheets, and that goes to like looking at the formulas within the spreadsheet for how they're doing it and where are you pulling this data. So there's not a black box behind what's happening for these valuations. And majority, particularly when you think about it in the retail space, where you've got all of the regulation, all of the compliance requirements, those type of things around these types of vehicles, there's methodologies that our clients are employing. I know that Brian's talking about using multiple methodologies, but there's methodologies they're employing based on types of holdings that they have. And those methodologies are standardized within their firm. That doesn't mean that they won't take another market data. That doesn't mean they won't look at secondary market information, but they have to be able to validate it as being actually market participant data that would, maybe it's not primary, but they could look at it and say, yes, this isn't a fire sale that I would have to look at. And I think the other piece that we always have conversations about in this space is material non-public information. So that becomes really important for thinking about when does something actually impact evaluation, and how are you thinking about that? And would somebody, a normal investor understand what is happening before you go through and impact that to your valuation? So those are all the things that we're looking at. But from a transparency perspective, when we're auditing it, we get behind the scenes of all of the things behind the curtain, as you said, to see what's kind of happening at the valuation level.
And then from a controls point of view, like we're then getting questions from Katie and other auditors as well. So there's a lot of checks and balances that are happening across these valuations, whether that be within my firm as an independent valuation firm, that we have our own controls or do our own reviews with independent oversight. Then you have the auditors doing their processes and controls, which include coordinating with both the manager and then potentially a firm like mine. And then you have at the manager level, there's all the way from independent valuation teams to independent valuation committees to the CFO's office, and in certain cases, independent boards, all with that oversight. So there's a lot of eyes the whole way through when you think about these valuations.
And I would just add, probably relevant for this board is, for us as a public company, our valuation controls are governed under our SOX framework and SOX compliant and subject to that review as well.
Okay, great. So we have Satyam, James, and then back to our questions, Gary.
Hi, maybe you could just distill some points that have been made across the table for us, particularly as it relates to data. You all have talked, I think, a few times about reliability, quality issues, and in the valuation space in private markets. So the first is I would just love to know more about the sources. And this is, when I was at the SEC, it was always a black box. Where are the sources for private data? How do we get them? It was always a challenge. You've talked, Brian, about the technology has helped solve a lot of the issues in terms of harmonization and the like. And I think, Paul, you mentioned public issuers. There's a lot of data out there at the SEC level for you all in the private space for public issuers. But I would love to know in particular, what are the outstanding challenges on data quality, reliability that you are facing? What are the hardest data quality challenges that we should know about? And where are the spaces that technology hasn't solved yet? Where do you think that hockey puck is going or needs to go to solve those difficult data challenges?
I'll start. So we always want to go right to the company's source data whenever possible. So that's what we see as, golden source. When we can get directly to their accounting system and be pulling data directly from there, that's a huge win. I would say some of the challenges are when that's not available or not realistic or doesn't fit with your information rights for the company. And so you are limited to using a PDF board deck and using OCR technology to kind of scrub that and making sure that the technology that you're using is pulling the right data. I think we're going to make a lot of progress in this, and some of the tools that Paul mentioned earlier are already making a lot of progress on that. So we'll just continue to see wins from that perspective. I think another thing is probably waterfalls and cap table management, waterfall management, and making, trying to harmonize that across your portfolio.
Yeah, and to Megan's point, the investments we're making are mostly in bigger companies with their own significant finance organizations, with a CFO, with a chief accounting officer. And so they've got their own robust processes. And the thing that we're thinking about is how to get that data in a controlled and consistent way from those organizations to into our valuation process. And so that's where the technology comes in. So I think that's maybe a qualitative factor to think about that helps with the control environment.
I think the other piece that's come into play probably over the last few years is just the availability of private market indices that are out there publicly for people to subscribe to, of course, and get access to. So you could see, for example, market movements when we're talking about some of these private assets and how clients are banking them to indices or benchmarking them to indices to see how they're moving with those assets during times of stress. That's one piece. Again, I'm going to harp on back testing. Backtesting is an important aspect to everything that happens within this realm. So once information becomes or audited information in private companies come available, making sure that aligns. And then we see our clients also doing a lot of adverse data searches to make sure that everything that you're getting from the company is that aligned based on all of the due diligence they've done. Does that align to what I would expect it to be? And is there anything out there in the marketplace that I need to be concerned about?
James.
Thank you very much, Amy. I'm really excited by this particular panel, in part because last week in a recommendation by the SEC IAC, the committee supported enhancing retail access to alternative investments while presenting some concerns and the need for guardrails. One of the concerns centers on valuations. The valuation concerns were presented with examples, primarily involving significant volatility. In this presentation, it appears that you are saying the valuation market is on top of the valuations issue, but is it really fit for purpose with enhanced retail participation? Are there lessons to be learned from the European long-term investment funds? How would you handle having a redemption gate for retail investors? Are disclosures currently adequate? And Brian, in the recommendation, there was good support for firms like yours as a major part of the process. However, it was also included in the recommendation pointing out that firms may not have to actually take your advice or can find others to provide the advice as well. And so I've asked a few questions, but it's basically around there's definite support for retail access, and we're going there. That's not even a question. But can you talk to the necessary guardrails that would in fact be different? I mean, around the table, we have institutional investors that have pointed out that they've had problems. And so what does that mean for retail investors?
I mean, I think that we have seen the valuation in this marketplace continue to improve because of the active market participants that are happening. And what I mean by that is that there are more firms, such as Paul's over here, that are flooding into the market to get access to that. And with that comes the requirement to get more data information. With that comes them making sure that they're assessing the reliability, because the vehicles they're putting them in are under regulatory requirements such as 2A5, which has a very strict framework as to, and there's still some wiggle room as how they apply it, of course, but a strict framework of how you look at these types of assets in the confines of not only 2A5, but under GAAP. And so what we're seeing is that the demands for that available information have continued to heighten. And if you want to be able to play in this market, you've got to be able to provide that available information. You've got to be able to provide that data. And that then provides firms such as Brian more information to be able to backtest, to be able to look at different things that are happening in the market. And all of that, I think the biggest piece to me, and I would be remiss as an auditor if I didn't say that it comes into, we need more documentation. Like, it's the documentation of what people are doing to be able to highlight how are you getting comfortable with this. It becomes extremely important in everything we do, and then how from an auditor's perspective we can go in and take a look at the marketplace. But I do think that is it fit for purpose for right now what we're seeing? I think yes, in certain aspects it is, because I think if you heard Paul talk about several times, is that the retail market is being cognizant about what asset classes they're going in. Do they have enough due diligence over it? Do they have enough comfort? Is there enough information they're going to get because they're doing the right things to, which is in the confines of their policies and procedures? And then we heard Brian give the waterfall of the controls, and what does that talk about even from a board perspective, because boards come into play with these vehicles, and how are they comfortable with it? So I think there's a whole the confines of what the private assets are going into now with the regulatory oversight and also the compliance has played a really big role in moving that dial of what's available.
So if I can follow up. So basically, that's when markets are doing well, when things are going well. I mean, even 2A5 and what you mentioned, the International Private Equity Venture Capital Valuation Guidelines, the assumptions that are made there are incredibly positive. I mean, the assumptions it's like a sale in a good market. But we're talking about what happens to retail investors when markets turn sour. We know they will. How do we protect them?
Just to clarify a point, the guide actually, I would make the argument that it's reflective of what should be done from a market participant perspective, regardless if it's a good public market or a bad public market. You should be reflecting the circumstances of the activity that's going on in the direct investment of the underlying portfolio company or underlying investment. So that's what the guide is there to help serve the methodologies to employ, and then ultimately determine based off of the situation, such as, okay, there's no round of financing, or this company is going through a liquidation. What do I do with that estimated value in the waterfall? And then ultimately, how does it trickle down? So it goes back to that unit of account. Am I valuing the company? Am I valuing the underlying instrument? What are the rights of that underlying instrument? And that's all going to play a critical role. So just wanted to clarify that point.
I think we're running close to time. I wanted to kind of tie a few other things together. We've talked about the challenges. Paul brought up liquidity and the challenges that we face there, and we've got some ways to limit liquidity with lockup periods, notice periods, redemption limits, and those type of things. And those limitations are really designed to ensure that the fund can maintain its investment strategy while maintaining investor expectations and liquidity effectively. But it doesn't take a lot of imagination, like James talks about, where we could have a breakdown in that, and we go from the focus on finding attractive investment opportunities to just simply finding a bid to answer our near-term liquidity needs. How should managers, valuation providers, and auditors stress test their models and controls to ensure fairness to redeeming and remaining investors?
So this is an important thing that we're all looking at, of course, because I do think it's developing a robust stress test program that says if this happens to valuations, what would happen to my liquidity? Making the right assumptions about what investors would do on the other side if you were in a tough environment, in a tough market. Playing out, if my realizations are delayed for a year, what would happen to my ability to satisfy redemption requests? If everybody redeems at the gate, what would happen? How would I satisfy this? I will say one thing that I do think is important to realize about some of these products is that the diversification of the underlying portfolio is a huge advantage. So these are generally evergreen products that invest across multiple fund cycles, and so they end up having, over 100 or even more underlying portfolio companies, underlying instruments, including the liquid portfolio, or really excluding the liquid portfolio in that 100 number. And so that provides a huge advantage for managing the liquidity.
And then what role do auditors play in this?
Yeah, I mean, I think when we're looking at the stress testing, we look at the stress testing in relation to how does that then kind of dovetail into kind of valuation. But there also, what we're talking about here is at the overall portfolio level. So there's different requirements depending on what you're looking at. So when we think about diversity in the portfolio, that's where it comes into the liquidity program that the clients put in place or advisors are putting in place to be able to look at it overall. Is my vehicle operating in the method that it's designed to, meaning can I meet that 3 to 5% redemptions if I need to? Am I stress testing and shocking what I need to based on some of the more recent trends that we've seen in the marketplace that have been a big shock, and would I be able to actually make it through and be fine? We see our clients looking at that using the trends and data for past history. From an auditor's perspective, what we think about this is in relation to valuation specifically at the unit of account. Valuation programs aren't typically involved in kind of a strictly financial reporting audit. But thinking about it in relation to how are they playing into liquidity for a market participant in valuation is how we look at it, and stress testing around that.
All right, I'm going to just wrap it up for this. Oh, sorry, Sandy. Did you want to have another question? We can. It's okay. Please proceed.
Okay. So I was hoping to get to this earlier. I wasn't watching the clock. I'd like the opinion of those people who might have one, Brian and Paul specifically, on what they think is happening in the private equity market over the last 3 years, and what they think could happen in the future.
This was not in the prepared questions, so.
Oh, I'm sorry. Well, this is like I've got them. They're stuck, right? They're stuck. Yeah.
The New York State of mind.
Right. Obnoxious investment banker Gina. Okay. You can tell me after lunch. So our performance numbers, New York City published, core U.S. equities, 12.5 10-year returns, 14.5 private equity returns. 3-year U.S. core equity, 12.5, private equity, 5.5. What do you think's happened over the last 3 years? And
yeah, I mean, I would just say it has been a period of strong returns in the public equity markets. And if you look back 30 years at private equity relative to public equity performance, typically in periods like this, you'll see private equity and public equities be roughly consistent in periods of strong public equity returns. Where the outperformance you see, again, looking at historical data, would be in periods where the public equity underperforms private equity. So really, I think, I don't have a crystal ball. It depends where you're seeing sort of the public equity markets going, from here, but private equity tends to perform in a more kind of steady kind of absolute return, less volatile, but again, can be, different depending on where you are in the public equity markets.
Okay, great. So I just wanted to wrap it up a little bit because I think we've talked a lot about this topic, but could probably speak a lot longer about it. First off, thanks so much to the panelists for being here. It's a lot of time that we've spent not only preparing, but getting here and speaking with us. And it's an intimidating group, I think. So thank you very much. Thank you to my fellow IAG members in participating and being so engaged in the topic. I think there are quite a few takeaways that we can formulate on and think about as it relates to the PCAOB and their involvement in the ecosystem associated with this potentially fast evolving realm for investors. So I really appreciate the discussion and look forward to the follow-up to come. Saba?
Thank you, Amy, and thank you, Gary, for moderating this very insightful discussion, and thank you to the panelists. We greatly appreciate it. We'll now break away for lunch and reconvene promptly at 12:45. Thank you.